Howdy there, folks. Welcome into this buy one, get two free in this one here today, folks. 3 videos up here for me to react to. First one up here, there are a lot of people who want in on this market, says my man Warren Pye is going to hear what he has to say in regards to that one. Then we're going to hear the Clintons talk about the Mag 7 and their expectations in regards to this. And the last one up here, you can still sink your teeth into the AI market. There's a big development going on in the AI space, and this might give massive upside still to NVIDIA stock. So we're going to speak about that. I think that's an important subject here today, okay? Only thing I need from you, smash the thumbs up, make sure you subscribe to the channel. That's it, folks, okay? And if you want to follow me on Instagram, by the way, pin comment down there. I haven't shouted out my IG in a long time. I'm always posting some Instagram stories and things like that. So yeah, if you want to follow me on there, that's a pin comment down there here today. Alrighty, guys, let's get into this.
And after closing above the 5,000 mark for the first time ever. So is there room for a rally to run or cause for concern? Here to weigh in on what he calls the bull market paranoia is Warren Pye, co-founder of 314 Research, to discuss. Warren, always great to have you on the show. I'm going to start right there. Paranoia, what are we talking about?
Yeah, great to be here. I sense that, and it's logical, right? I sense there is a lot of paranoia out there and fear in the market, and I think there have been a lot of people who missed the rally. And we're up 19%. At the end of January, at least, the S&P 500 was up 19% in 63 trading days. So that's, for people who don't count in trading days, that's one quarter. And that puts us in a top 3% kind of move. So it's been a massive move. A crazy run, and we're overbought. I mean, that's in logic tells us that the next move should be some kind of serious correction. You give a lot of those gains back, and so I'm prone to the paranoia, prone to the skepticism and pessimism, just like everybody. But so what we do is we use data to combat that, and we look at the data and study the history of overbought markets like this one. The message is really clear. It's actually a bullish phenomenon. You end up with a pullback or consolidation, and the pullback's usually pretty mild, and then you continue higher in the year following. So we've had 12 of these events, these 19% surges, as we call them, and there have been very little pullbacks in that data set. And so I think that the paranoia and the concern about an overbought market is really misplaced. You should probably flip the way you look at the world and think of this as there is a lot of demand for stocks, and there's a lot of people who want into this market.
First off, look at Warren Pye's neck and tell me that man doesn't lift. You know he lifts, okay? So here's where things get interesting, okay? So if you've been following my content, you know I've talked about, I feel like there's probably a pullback at some point in February, March, right? And kind of, I've been calling for that for a while. Now, here's where things could explode to the upside, okay? NVIDIA earnings. Let's say NVIDIA comes out and knocks it out of the ballpark again. That will flip this market even way more bullish than it's at right now, because that is the big worry of everybody worrying. Like, the big worry on the stock market, even over interest rates in my opinion, is NVIDIA going to keep this up? And if NVIDIA breaks, it's going to break the market, right? If NVIDIA comes in and knocks out of the ballpark again, especially with their guidance, oh my gosh, everybody's going to flip their flapjacks, and we're going the next leg higher, right? And there's going to be another huge bullish move, and that big pullback that I thought we'd get in either February or March, we won't get it if NVIDIA actually comes in and smashes it again, because there will just be so much upside momentum. It'll push Meta way over 500, probably to 550. It'll push NVIDIA up toward 1,000. It'll push AMD to 200. It'll be a kind of a little skyrocket ride there for a month or two. But at the same time, we're going to have that pullback at some point in time, right? We do know that, but just, you never want to bank on these things. You never want to bank on like, I think for sure we're going to have pullbacks. So that's when I'm going to be able to buy. So by the time you get to that pullback, the market might have already climbed another 10, 15%. And like whatever you thought you would get the deals, this is a problem, okay? And I know people like this in real life, right? Some of these people think they can time it out. I'm going to buy this stock when we get the big pullback in blah, blah, blah month. And then the pullback never comes. And they're like, oh. And so they never buy the stock. Or the pullback finally does come, but they're still buying the stock for a more expensive price than when they were talking about buying it 3 months ago, 6 months ago. So it's a flawed logic, and it's just another thing that you think you can time the market. At the end of the day, I buy stocks every single week. Every single week. Keep it simple, man. Keep it simple. Don't think you can time the market. If you want to try to make predictions, throw darts at the dartboard, do it for the fun of it. Don't do it based upon an investing strategy. because it is a failed strategy.
I think we're going to get some sort of pullback, maybe a mild one, consolidation, and when that happens, you buy.
Yeah, I mean, we haven't adjusted our positioning. So our message since November has been, you can't be underweight this market once the Fed made its pivot, verbal pivot, that is. And so we're not adjusting our positioning. We're not trying to time a top or anything like that. I think that's a really mistaken strategy. If you have some dry powder, we have a cash overweight. We've been running a bond underweight, and that's funding our cash overweight. And so the idea is, if we do get a sharp correction, say 7-10%, then yeah, I think you put that money to work, assuming all of your data and framework is still constructive. But at the end of the day, I don't really think the market's going to give you that picture perfect pullback. Honestly, I think a lot of people are underpositioned, too afraid of this market, and behind the eight ball. I think the best bet is still what we called for, is that the market gets to 5,200 by May. That's the first Fed cut. You end up with a 10% rally from the 6-month period before the first Fed cut and a soft landing. That's our script. I think that's what we're following in the market has been actually even better than we expected from that perspective. So
that's the moment. If you want to know the one moment I'm thinking high probability the market goes down, will I bank on this? Will I play put options on this or call options, or specifically this is when I'm going to buy? Hell no. I'm not going to bank on this. But if I'm going to throw darts at a dartboard for the fun of it, the moment I think the market gets hit heavy is the moment the Federal Reserve announces they're going to cut rates. And when that actual rate cut goes through, that's when you see the market do I don't want to say a nosedive, but let's call it a pretty big fall, because everybody's expecting the opposite. The first rate cut comes, and the market's going to sky. What do we know about the market? Buy the rumor, sell the news, right? So we already have priced all that in, the rate cuts and all this sorts of things. And so by the time you get to the rate cut, all of a sudden, the market starts actually downtrending, right? And then from there, the market downtrends all the way until you either get to a recession, or it's like, no, we're avoiding a recession, we're back up from here, okay? And so that's kind of my thought process in regards to that. And so you could have a downtrending market that maybe lasts, a few months. You could have a downtrending market that lasts 2 or 3 years, right? But that's if you get to the actual big recession, right? Which there's a whole debate if that would happen or wouldn't happen and those sorts of things. So, but yeah, and by the way, one of the most bullish things for the market overall is when you're breaking all-time highs. When you break all-time highs, it's usually very bullish for the market, and it's a signal that we're going actually up a lot higher.
Yeah, if we get a pullback, I'm buying it, but I'm definitely not anticipating that here.
Okay. 2 things you said I want to parse out. The first one, we know this rally has been top heavy. We've been talking about the Magnificent Seven and the role that it's playing in the gains that we've seen. Is that where you continue to put money to work, or are we going to see this rally broaden here anytime soon?
And the rally is broadening, and so that's that's part of the paranoia and bear concern out there, is that the breadth has been so poor. And so you're seeing things like percentage of stocks trading above their 50-day. It's starting to trend lower a little bit. It's still decent. And so there, you see that as a concern. But when we control for interest rates, you're starting to see sectors like financials, sectors like industrials, sectors like healthcare, even consumer discretionary join into the tech sectors and participate in the rally. So I think you have to control for interest rates because that's been your dominant factor in the market. How do you play that? You don't want to be underweight the Mag 7. I mean, this is just a momentum train that you don't want to miss. But our view has been a little bit nuanced. We want to be in high quality stocks within the S&P 500 and shade. If you can find those high quality stocks that are not Mag 7, that's going to be your sweet spot. We run a system. We call it our full cycle trend system. It's up over 8% this year. It stuck with the market last year and beat the market by 10% in 2022. Quality is really always the consistent factor that outperforms. I wouldn't chase cyclicals. I wouldn't chase value. Very
quickly, I think you said you're underweight treasuries. Why, and what would change that?
So we think fair value on the 10-year is about 4.2. So we're pondering getting back to benchmark weight on treasuries. But you have some issues like supply and ultimately, I think that the bond market has discounted a lot of the Fed cutting. On the other hand, the Fed is going to cut. So I think these kind of factors, I see a lot of bearishness calling for 5% on the 10-year. And we saw that and expected that last year and went overweight when we saw that. But I don't see the 10-year going back to 5%. I think we're going to trade in a range 4 to 4.4, let's call it, for the foreseeable future, as you fight
That's
supply
fair.
versus Fed cuts, and you're at fair value.
Totally fair. Man's talking about benchmark rates. I'm thinking, man, I want to hit the bench with you, Mr. Pies. Okay. All right, time to hear the Clintons talk about the Mag 7.
Another record closing high today. The mega cap's already sitting on double-digit gains, and substantially so for the year. But can this narrow leadership continue to grind higher? Let's ask Doug Clinton of Deepwater Asset Management. Welcome, Doug. It's good to see you on this Friday.
Likewise, Scott. Happy Friday.
You too. I've run out of superlatives to describe what's happening. Some who are even positive and invested use the word insane for some of these mega cap gains. What words would you use, and how do you feel about what you witnessed?
Okay, hold your horses for just a flippin' flapjacking moment, okay? Listen, you can describe the gains as insane, but don't describe the stocks as insane or the valuations as insane. Because that's where we have a big divergence in this market between valuations that, based upon growth rates, don't even look very expensive on several of those big Mag 7s, right? Just because the stock prices have gone up a lot from the lows that they were back in 2022 when the market crashed and all those stocks fell 50, 60, 70%, does not mean those stocks are now insanely valued. It's just been an insane move to the upside. And there's a big difference between that, and people conflate the two.
Well, when $1 trillion market cap is up 50% in a month, I think that probably fairly qualifies as insane. You know, we are big-time tech investors. We have a lot of love for the Mag 7. But I think as rational people, too, we look at some of the moves we've seen over the past month, really the past 8 weeks. And at some point, you know, these $1 trillion companies can't keep adding a couple $100 billion to their market cap every single month. So my view is at some point we will get a break. We're sort of due for a breather. Maybe we're due for a little bit of a pullback. I don't know if that happens in a week or longer. Obviously, the market can be insane, to the word of the moment here, for longer than we think. But longer term, that's how we like to try to look at these stocks and not try to play the short-term trends. All of the Mag 7 continue to have really great optionality as it pertains to AI as an emerging technology.
The problem is these stocks have a pullback and it gets bought up right away, right? Meta can pull back 3% in a day and then it's bought right up. And next thing you know, it's a new high. Same thing with NVIDIA. So they do have pullbacks. And, you know, stocks will go down for a day or two and, you know, draw down 3, 4, 5%. And then it's bought right back up. Why is it getting bought right back up, right? You got to ask yourself that. Because the stocks are undervalued. Meta's still extremely undervalued. NVIDIA, likely undervalued. That stock's fair value right now should likely be in the $1,000 to $1,500 range. You could push $2,000 on NVIDIA stock right now if they keep anywhere remotely close to these growth rates up over the next couple of years, okay? That's why these stocks are getting bought up every single dip. They're there to buy, right? Same exact thing with Amazon. Look at the bottom lines of these companies. They're increasing 100%, 200% year over year. You're going to pay a big price for that, right? You're willing to pay up quite substantially. And you can make an argument that they're not paying up enough.
We think over the next several years, a lot of these companies will have benefits that will see flow through to earnings, and I think can continue to support these stocks outperforming some of their peers in the broader S&P.
I don't know if this is just too much of a softball loaded question is to ask you which one of the group looks more insane than the others. And I only qualify my question saying, well, NVIDIA is like literally going to the moon every day. So maybe that's the easy choice. But is it necessarily?
I don't think it's necessarily NVIDIA. I mean, the tough thing, and again, the insane thing with NVIDIA is even though the stock is up 200+% in a year, the multiple really hasn't expanded that much. So a lot of it has actually been supported by a very rapid increase in demand for their GPUs. All of the hyperscalers obviously are building out infrastructure to support their investment in AI. So I probably wouldn't say NVIDIA. I might give you a little bit of a divergent answer. I'll tell you the one that I'm actually the most frustrated with, which maybe means it also to some extent could be insane, but it's Google. I mean, we own it. We are shareholders in Google in our core Titan fund. And the thing that's super frustrating about them is the stock's up 50%. Why should we be upset with that? It's because they should be the leaders in AI, and they just haven't been. You know, OpenAI, I think, is clearly 2 steps ahead of them for all the data that they have, 20 years of search data, for all the distribution they have, billions of users touch their products every single day. We think they should be in the lead in AI, and they just haven't shown the hunger, they haven't shown the fire to really be aggressive going after AI. And we think that that could be a mistake. We'd like to see them get...
Oh, gosh. Okay, hold on. Okay, and I'm not even a Google shareholder, but let me stick up for Google for a minute here, okay? Listen, there's going to be a lot of different ways to play AI, okay? It's not just about a large language model and that's it. And whoever wins that wins the whole game. No, okay? AI is already playing a huge factor in terms of Google search, what Google's feeding you for news-related things, how YouTube works in general. Like, Google is one of the best AI companies in the world, and that's nothing new to them, okay? And so if ChatGPT, let's say, is more successful when it comes to large language models, that does not mean Google failed. Google, you suck now. No, that's not the way this works. That's not the way this works at all. And also keep in mind, Google search wasn't the biggest search engine for a long time, okay? There was a long time period, and I've been around on this planet for long enough to remember this. And some of you guys that might be older watching this right now, you remember, what did we used to use for search back in the day? Yahoo. Yahoo's what we used to use. And there was also another service that was pretty popular for a while called Ask Jeeves, okay? I didn't even start using Google search till probably I got to college. Like when I got to college, like 08, 09, I think I started using Google search a little bit, and then I really started using it in 2010 and beyond, right? Until before that, it was like Yahoo search was how I did it, or Ask Jeeves, right? And so, you know, you can't say, well, because this company's winning right now, they're going to win forever. It doesn't work like that also. So, I don't know, man. There's a lot of factors at play here, and it cracks me up when people say, oh, this company is just like, you know, there's so many beneficiaries in AI when you really look at it. I mean, you could go all the way down the list to the company like the Palantirs. We could talk about AWS as a huge beneficiary. Google Cloud is going to be a huge beneficiary from AI. Microsoft's obviously been a big beneficiary. NVIDIA's obviously is, right? AMD will be. I mean, there's so many companies. Even you can take it to memory chip related companies like a Micron. It's a long list of companies that are going to be benefiting from AI. It's not just one and Google lost and everybody else lost.
A bit more aggressive with the products they're putting out.
Do you own it or not?
We do own Google. We do. It's one, again, as I say, it's insane maybe to be frustrated when the stock's up so much. But as shareholders, we think there's more there. So I actually think it's insane that they haven't been more aggressive, because I think that they're leaving a huge opportunity on the table.
Meta is really the standout of this particular period, just because their earnings report was
going a lot higher,
amazing.
Mr.
And then the stock's reaction was just... I was like shocking to look at how much it was up, coming off the best year ever last year. Of course, you own this stock. Do you like it the best in the group?
Meta is our favorite in the group. I think that the year of efficiency that Zuckerberg undertook a little over a year now has really set a new tone at the company. And when we talk about AI, the pace of innovation here, it feels like every month it's like 3 years of development in the old world. I think that year of efficiency has really set the tone at Meta in a way that Google has not figured out how to set the tone. One of the things that I think is actually very underappreciated for Meta, and we've seen it to your point in the numbers in the last earnings, the thing that they still have that could be a huge business in the future is their open source model business. Right now they have the leading open source AI model in the world, that's Llama 2. I think it's downloaded something like 30 million times in the last couple of months. I believe that over time, Mark Zuckerberg is going to use the playbook he has always used with every product he's developed. You figure out how to get 1 billion users to use a product, and then you really figure out how to monetize it. So he talked about some of the tangential benefits they're seeing from Llama now in terms of interest from developers working with Meta, improving their internal models. But I think over the longer term, we're going to see them provide some different services around Llama that could be a multi-billion-dollar business for them, maybe over the next 2 to 5 years.
Yeah, dude, there's so many growth areas for Meta, it's ridiculous. So, yeah, that baby's on its way to 500 and then 550. Next one up here, you can still sink your teeth into the AI trend.
For the tape.
And the best thing with Meta, on top of the growth, all the growth opportunities, everything like that, is the fact that the company is trading at a forward P of like 23. For their growth rates, it's like ridiculously low. Like, that's insane.
Rally and risk, whether the latter is increasing as the S&P keeps rising and some big name stocks go parabolic. Let's ask Adam Parker. He is the founder and CEO of Trivariate Research, a CNBC contributor. Good to see you.
Great to be here.
Do you marvel at this market like just about everybody else?
I think the bull case we talked about, gross margins can go up for the average company. You'll think earnings are growing in the middle of this year, next year, and so forth, and that the Fed's likely to be accommodative. That cocktail's still in place. I mean, valuations have moved a lot, but as you know, valuation is never a good predictor of near-term return. It's about believing the economy is going to be in reasonably good shape, and I think the data points support that.
So you think that the environment, all of the things that you said, plus other things you didn't mention that are potentially positive, support the stock market at these prices?
As long as I think gross margins can go up and earnings are growing, I think history dictates being reasonably optimistic on equities is a good idea. And I can't find other asset classes that give me exposure to things like the top 20 U.S. equities. I mean, we talk about that all the time. The biggest 20 U.S. equities grow their net income at 15% per year. So what else do you see that's awesome, that's big and liquid and all that? So I think it's a good risk reward. What am I worried about? Maybe China gets worse. That's really hard to wrap your arms around. Maybe the U.S. consumer slows. We've seen some little signs that the low-end consumer is slowing. You got to monitor that. I'm worried that, that maybe you could.
And the great thing for some of the strongest stocks out there, right? Some of the strongest stocks are certainly two stocks I own, right? Meta, Amazon, the number 1 and number 3 biggest position in the public count. Guess what they don't really have? China exposure. Amazon and Meta have Meta's almost no China exposure, and Amazon's like almost nothing. It's like hardly anything, okay? So those companies, doesn't really matter what's going on in China. NVIDIA now at this point in time is actually very little reliant on China at all now at this point in time, right? So, and those are, when you think about some of the strongest stocks in the market, you think about Meta, you think about Amazon, you think about NVIDIA. And so the whole negativity around China is just, it's not hitting those stocks because people are like, well, these companies don't really get any money from China anyways.
Get the balance sheet stuff from the Fed, kind of offsetting some of the accommodation of it. I mean, nothing ever feels, you always feel, as we talked about a million times, you always sound smarter when you're bearish. But I think if you think margins are going up, you should stay optimistic. And I see so many things I want to buy in the equity market underneath.
Really? Yeah. We'll get to that in a minute. Yeah. Before we go underneath, I want to stay above.
Okay.
So to speak.
Let's cruise at altitude.
The 2 E's, exuberance and euphoria. Yeah. You worried about either of those?
Look, what I do all day long is I talk to portfolio managers and CIOs and big, senior people at corporations. I don't see a lot of, champagne and Maybachs or whatever you want to call it. I think people are.
You looking around NVIDIA's corporate headquarters?
Yeah, well,
there's some Maybachs in
I think AI
in the corporate parking lot there.
I think you picked a stock that's been a monster, and we've talked about it a lot on your show that. You need exposure to AI. If you're a fund manager and your boss says to you 5 years from now, what did you own for exposure to AI? And your answer is 0, you're fired. So you have to look around the 9 or 10 businesses that participate. We're in the first inning of a multi-year trend, and they're a winner. Everyone thinks that they're the genius that's going to call the right part of that lightning bolt. They think today's the first part of lightning bolt to sell it, and that stock's proven wrong. Like that's an early trend. So I'm not smart enough to get that right. I just know we're headed. We talked about it.
You're a former chip analyst. Yeah. I mean, you know chips better than most people.
Yeah.
And somebody else used the inning analogy with me earlier, saying this first inning of AI. I said, well, if you look at NVIDIA, they're doing like 9 innings worth of gains in the first inning.
Yeah,
you can't keep that pace up.
No, you can't keep the pace up for sure in terms of the amount. But when I look at it, and we did a big note on it today, actually, like when is the time to toggle to the industrial-centric semis from the AI-centric semis? That's the title of our note today.
Like the NXPs and the
ADI coming up, Texan, Microchip.
Semis.
Yeah, great businesses. They all guided down. They all have way too much inventory. They have more broad-based economic exposure and don't have a lot of AI. It's hard to own them when I don't think gross margins can go up and they have a lot of inventory. I can still sink my teeth into this AI trend for the time being. I think at some point you'll want exposure to them too. They're good businesses. I just think it's too early. So, look, our call coming in the year was to software that is accelerating growth and to AI-centric semis, avoid the industrials. I think that's still right. I do worry about the EV to gross profit or the valuation, but I know that's not the leading variable I can use to pick stock.
So last year I told everybody be very, very careful. Very careful. And what did I say be very careful of? All these people that wanted to short NVIDIA stock and try to bet against this one and all the numbers aren't going to keep going up and those sorts of things. I said be very careful, okay? They just started this new chip cycle in regards to AI chips, right? And it just started to hit, obviously, in the back half of 2023, and obviously it's going to hit in 2024 in a massive way. And the thing I told folks is usually these chip cycles, whenever NVIDIA goes on one of these big chip cycle bull runs, it usually lasts 2 to 3 years. 2 to 3 years. So let's say we started last year. This is probably going to continue on for at least this year and probably into 2025. And so at some point in time, maybe NVIDIA will be an attractive stock to buy some puts on. But you could be waiting until 2025 or 2026 for that opportunity, right? Because usually when you get one of these big cycles in NVIDIA, it's multi-years. And so you're waiting around for a bit. And by that time, your puts already expired worthless, so you lost unlimited amounts of money on your short position if you got a short there. So you got to be careful there, guys, okay? All right, guys, appreciate you joining me as always. Thanks so much for being here. Thank you for being subscribed to the channel. If you want to follow me on Instagram, that's going to be the pinned comment down there. Got 83,000 followers on there. So, yeah, you could be on there as well, okay? Follow me on IG. Much love and peace.